While the market continues to rally, it's becoming more and more obvious to me that the market is not accurately pricing the story of events that are occurring in the economy with regards to the Fed and with regards to multiples. So we're going to break some things down because we don't want to let price dictate sentiment. That's a very important rule. We don't want to let price dictate sentiment. It's very easy when the market is rallying, if we're short, to change our tune, to get long, and to think this is going to keep going on. But if you look at things, it doesn't really seem like it can keep going on for a very long time. And you have to ask yourself, what is the bull case? Where is it? How has it evolved over the past several weeks? Because it has certainly evolved, and I can't keep track of it because it's all over the place. So let's break down the bull case as we see it. And if you happen to have a bull case, you can leave it in the comments. And if you want to come on to this live and debate, we can do that. I would love to have a debate and do this live and engage in that kind of dialogue. We can do it this kind of hour or an earlier video. But bull case, from my understanding, beginning of this year, when we were at the lows and the Fed hadn't spoken, we were kind of having a reset moment, and the market was making a local bottom, the bull case was the economy is going to crash, the Fed isn't going to be able to do all its work, they're about to be done tightening, and they're going to start cutting. Okay, that makes some sense. If the Fed decided to ease at some point soon, I could get behind that bull case. That, okay, maybe things would go that way. Additionally, they were saying, earnings are going to hold up, these kinds of things. Okay, we'll get to that later in the video. The market continues to rally every time Powell speaks, and it's a volatile rally. It doesn't feel very substantive. It's rallying off a single word that he says, like disinflation, which he came today and had to add additional nuance to and correct because the market took disinflation and ran to the maximum possible extrapolation that it could. He said today, the disinflation process, okay, first of all, it's not a disinflation, it's a disinflation process, has begun, but there's a lot more still to do, and we might have to hike beyond what's currently priced in. Notice, he didn't do a whole lot of talking about possible cuts. He didn't do a whole lot of talking about possible anything dovish. He didn't talk about anything dovish, about actually doing things that are dovish. He, in my opinion, without trying to look at the market reaction and let price dictate my sentiment, was hawkish. He was directly trying to, at every chance he could. In the last conference, what he did was he would say, well, if the data comes in hotter, we'll hike. If the data comes in cooler, we'll cut. This time, the big distinction was he just did the hawkish side. That's all I heard. That was my read on it. All he did was the hawkish side. He could have very easily also said, we'll also cut. I don't think he ever mentioned cutting. I really don't. So that is a pivot, in my opinion. That he did kind of mention cutting last time. He didn't talk about it this time. So if that is taken off the table, then where does the bull case remain? Does the bull case... Oh, and one last thing. Bostic talked about a 50 basis point hike yesterday. We got CPI next week. I think it's going to be hotter than expected. We already have Spain and South Korea reporting hotter than expected. We know gas prices are up. Lots of various commodities are up. I think it's going to be a reacceleration of CPI. We just saw what the jobs data was. It's coming in hot data. Anyways, in my opinion, the bulls can't rely on the Fed. The Fed is not their friend right now. They are actively being more hawkish and more hawkish than the bears tried to price in. We saw what rates did this month. They came down. We saw what they did initially after the Fed meeting last week, Powell's first time. They're now above where they were before Powell. The market has not corrected that. It has not gone below where Powell was, but I expect it to imminently for this reason. We just got Chipotle earnings weaker than expected. We happen to be short Chipotle. We're still at a loss on it. We need a little more to break even on that. But the principles here are very straightforward. The Fed is tightening, okay? Michael Burry, I don't know if you saw Michael Burry's return tweet, his first tweet since the sell rating. He was comparing, essentially, the dot-com bust to the current bout we're in. If you remember, in 2021, he was saying it was the biggest speculative bubble in the history of speculative bubbles. I mean, he might have been right about that. We had cryptocurrencies, we had Sam Bankman-Fried, all these kinds of things. He posted a chart of the dot-com decline and said, maybe it's different this time, or something along the lines of that. Why would it be different this time? Because he also posted in that same chart the Fed easing as the market crashed from the dot-com bust because valuations were so high. This time, valuations were so high, we printed money, we had 0% interest rates, which we did not have in the dot-com bubble. We saw foreign currencies, all this crazy stuff. This time, the Fed is tightening going into that. So that's a big deal. Valuations are still not cheap. They're still not fully corrected, in my opinion, and probably in the opinions of others. So the earnings picture is starting to look weak. Let's not forget, people are trying to cling to the same forces and the same prices that we had with tremendous growth in the economy, tremendous growth amongst corporate earnings, the ability to take price, stimulus checks, all these kinds of things. They're trying to get back to that and using that paradigm. When the current paradigm is not that, it's very different. And we can't price stocks the same way because their earnings are declining. They're contracting. In addition, the Fed is taking money out of the system. There's going to be less money. Companies aren't going to be able to take price. Interest rates are higher. So why would you buy stock at a tremendously high multiple and have to wait 20 years to get your money back, and hopefully it's at a reasonable multiple by then, when you can just buy a bond and get paid? I mean, it sounds boring, but that's how the world works. You invest money because you're supposed to get a return on that every year. You're supposed to get paid. You know, you're going to build something, it's going to grow. You don't invest money to get ripped off, right? You don't invest money to get ripped off. And that's what's happening. So, there's got to be some, in my opinion, corrections here. We're seeing mega cap tech coming weaker than expected earnings. Amazon didn't even make a profit last year. They're a huge company. So the economy is weakening. We see Chipotle. That is a very middle-class stock. And we're going to have to see more of what happens. So obviously today's a very strange day. Super strange, super weird. I don't think fundamental. I think it's a lot of, the retail inflows, that kind of stuff, whatever. It's weird. But anyways, that is today's video. And until next time, peace out.